Hello viewers and welcome back to the TheStopHunter. I'm Stephen Hode, and in today's video we will be taking an in-depth look at the Williams percentage R indicator. Fabulous indicator. We're going to pull it to pieces, look at the history of it, how it works and how you can build it into your own strategies. Also going to have a look at some of my strategy ideas and sort of outside the box thinking of how you could apply this indicator, as well as the markets and the time frames and all the bits and pieces you will need to know when using this indicator. So let's get started. Now, Larry Williams is one of the godfathers of modern technical analysis. He's up there with people like Wells Wilder from the 1970s, creating many new indicators and tools. One such tool was the Williams percentage R, developed back in 1973. And Larry Williams is not just a technical analyst, he's also a very, very successful trader as well. One of the most famous figures in the industry, known for winning the World Cup Championship of Futures Trading back in 1987, where he turned $10,000 into $1 million in just 1 year. So he really does know his stuff, and he used technical analysis to get there. And one of the indicators, the one that we're going to look at today, the Williams percentage R. So what is the Williams percentage R indicator? Well, it's a momentum indicator. It measures momentum. So let's break down how it actually works. So this oscillator measures the level of the close relative to the highest high for the look back period, usually 14 periods. Similar to the Wells Wilder input 14 there. Someone asked me before why 14. I think it's just because, you know, it worked for them at the time before computers, manual charts. 14 worked nicely, stuck with it, and that moved on into today's world. But the formula there, Williams percentage R equals, in brackets there, highest high minus close divided highest high minus lowest low times minus 100. Note that minus 100 there. So we got a minus 100 to 0. So if the close is near the high of the range, percentage R will be close to 0, signaling overbought conditions. And if the close is near the low, percentage R will approach minus 100, signaling oversold conditions. So here's an example of what it's looked like. It's on TradingView charts here. This is just gold. I can actually chart 1 hour. It doesn't matter the chart or the time frame at the moment, just to show you what it's about. You can see it down there at the bottom. They're highlighting it there for you. Very simple oscillator, really. You want to find it on TradingView, go up to indicators, type Williams. And if you stop there, you'll see actually some of his other tools that are defaults in the TradingView toolkit. He's also done the alligator and the fractal. Percentage range, there it is. You just click on that and it'll add it to your chart, and then you can tidy up the colors as you see fit. Just have a quick look in there, see what you got. You can see the standard default 14. There's the, well, it's actually created its own bands here at the 20 and minus 20 and minus 80 level, and a mid band at the minus 50. Remember, it's between 0 and minus 100, and like I said, you can change the colors as you see fit. So that's just the basic indicator. We're going to dive into that in a bit more detail in a minute. But what markets, timeframes and charts work best for it? So in terms of markets, it's a very versatile indicator, making it applicable across a whole wide range of markets. You know, you can use it in stock markets, so it's excellent for identifying short-term tops and bottoms, particularly in individual stocks or stock indices. Commodities, you know, for spotting those trends in markets like gold or oil or agricultural commodities, where pullbacks can provide great entry opportunities. In FX, for spotting, you know, overbought and oversold conditions, especially in ranging currency pairs, and cryptocurrency, and you know, the volatility you get there. The Williams percent R can help you capture those, you know, mad swings, you know, especially in, you know, more the stable cryptocurrencies like Bitcoin and Ethereum. And what about when it comes to timeframes then? Well, it works well on all of them pretty much. Pretty effective there on shorter and intermediate timeframes. For example, 1 minute to 15-minute charts, ideal for day traders looking to capitalize on quick momentum movement. Hourly charts for those swing traders out there, 1 hour, 3 hours, that sort of time frame. You want to catch the reversals during a trading week. And daily and weekly charts for the long-term traders / investors. You can use it to spot major market turning points and divergences. And also, don't forget, apply it to other chart types as well. It's not just for bar charts and candlestick charts. You know, Heikin Ashi, we've seen an example already there, but Renko as well, my favourite chart type. So let's have a quick look at it on the Renko charts. So all I've done here is just convert the gold Heikin Ashi chart that we looked at earlier into a Renko chart. And as you might be aware, the Renko chart likes to get rid of the noise, you know, really focusing on the price action, makes it more defined. And as you can see, that has an impact on the oscillator there, the Williams R. Now down the bottom you can see those, you know, points, turning points, way more defined than what they were previously with the Heikin Ashi chart. So, you know, I favour the Renko charts, and building the Williams %R into them can be a very good tool to use. Now most traders will use this indicator to spot overbought and oversold conditions, and the key levels to watch are -20 for overbought and -80 for oversold. We can see the chart here. I've just converted the gold back to Heikin Ashi, and you can see down the bottom we got like oversold and overbought conditions, nearly touching there, down into there, down there. You can see actually by turning it back to Heikin Ashi how less defined it is than on the Renko chart. But nonetheless, when the indicator crosses above -20, it's telling you the market might be overbought, and when it crosses below -80, oversold. But you know, here's the thing: you can't just rely on these levels alone. So that's my experience of using this indicator. Just because an asset is overbought doesn't mean that it's going to keep on going higher, especially in strong trends. So that's why it's crucial to combine Williams %R with other tools and start to think how to use it sort of outside the box. So let's get into some ideas, and the first one here is trend confirmation. So one of the best ways of using Williams R is for this purpose. So let's say you're in an uptrend and the price is above the 50 moving average. You can see that's the blue line there on the chart. Instead of using the Williams R to predict tops and bottoms, you can use it to time your entries during pullbacks. Now, sticking with the gold chart, switch to 4 hours. Have a look at the Williams R at the bottom there. So we're looking for, you know, this oversold sort of condition, and I'm going to use the more obvious examples here. You know, right here on the right hand side, that goes dips under the -80 and then comes on back through. So you can see the trend, it's been nice and strong. We've had this pullback here in the price, and then the Williams R is telling us to get back in, you know, with this setup here using the Heikin Ashi. We've also got this bar in the middle here, which is like a doji, which is also a reversal sort of warning for us as well, added together. And we time our way back in. And you know, this, like I said, was an obvious example, but just to go and have a play, you know, using that as a way to get back into the trend. So you're not fighting the trend, but rather using the indicator to time your entries. Now the second idea here is divergence. Is not normally my thing, but just showing you how to find and use them using this oscillator. Anyway, we've got bullish divergence. Switch this to the GBP USD currency pair 3 hour chart. We've got this price coming off down here, and we've got the divergence. It's a bullish divergence, as the Williams %R is moving upwards, as you can see there, and that's forcing the price. We're getting that squeeze in that pattern there, and then, you know, the price moving, like I said, going on up. So we've got that sort of pattern. Draw it up there a bit easier. You know, a bullish type divergence. Like I said, hard to spot, very discretionary, but it works for other people, and it does work nicely on the Williams R. So let's get into some more unconventional, outside the box type thinking on using the Williams percentage R. And the first one is going to be as a market strength indicator. Really simple one, this one. Got the S&P 500 on daily chart here. See the indicator at the bottom there. I've highlighted the middle band. That's set, as you can see. Let's just drill in there to get the settings so you can see them. You can see minus 50. And the rule quite easily is if it's above the line, above that 50, minus 50, it is bullish. And if it's below it, it's bearish. So you can use the filter there to work out the trend, the direction, the side you want to be on. If you just draw up there, you can see we're above 50 here. It's all nice and bullish, and as it goes below, we can see there, we can see it's bearish. See it working quite nicely there on these examples on the S&P 500. Now another simple one, number 4, mean reversion trading. Very simple again. You may or may not have heard of mean reversion trading. We're just looking for the price that's moved away from, say, a mean, an average, and it's going to head back there. So we could use, for example, this one's just the FTSE 100 3-hour chart. You can see how the Williams are showing to a minus 80. It's moved below that, oversold, and then it comes on back up. Now in this example we can see here, we can see that I've just put on a Bollinger Band here, for example. You can play around with your own setup, but the price has just moved outside the Bollinger Bands there. We've got that corresponding minus 80 move and up, and guess what happens to the price? It goes on back to the mean, which is the 20 moving average. That blue line you can see running through the middle there. So that would be the trade between there and there. We might have further rules from there to there. Other tools you could use, VWAP with bands around that as well if you're into stock trading, but go and experiment. But mean reversion trading, another way of using the Williams %R. And also don't forget other charts. I know we already looked at Renko charts. They're one of my favourites, and like I said, I use a Williams R on those. You've got loads of other chart types you can try. Point and figure, Kagi, line break. Give them all a go. See what you can come up with. But as you can see here, this is the NASDAQ 100 1-hour chart. Just look how defined the overbought and oversold conditions are. We move on up through there. You can see, obvious examples get out when you come back on down through there, something like that. Very simple strategy. Again, I wouldn't use this just on its own. I would maybe combine it with other indicators and inputs. So why don't we just have a little play and see if we can come up with a strategy on the NASDAQ 100. Using a Renko chart and the Williams are indicating, try and get some hypothetical backtest results out of it. Right, so here is my experimental strategy on the NASDAQ 100. We're sticking with the Renko charts and obviously the Williams percentage R, but we've added a few other bits and pieces onto it. But before that, up in the top there, you can see I'm using a 1 minute Renko chart. I've derived the block size by looking at the 5 and the 15 minute Renko chart, the same market, NASDAQ 100. I've taken the two block sizes from there, the ATR of them, and I've added them up, divided them by 2 to come up with 16.5 points, as you can see up the top there, as the block size for this strategy. Doing that to take out some of the noise by creating a little, larger block sizes, but trading it on the 1 minute chart, so it gives us, the block size printed more quickly, so we don't lose any sort of movement in the price. And what's the purpose of this strategy? Well, it's really to I would say still capture momentum through the Williams R while still trading the trend. And in terms of other indicators that I've added on here, we've got here, as you can see, the super trend indicator, inputs 14 and 2.5, and the only other indicator added is a moving average of 50 periods. So what about the rules? Right, there's three main parts, starting with the super trend. Obviously we want that to turn, so we're looking at bullish trade first, and we want that to turn green, and then we want the price to be above the moving average for a bullish trade, which it is, so that's good. And then we head down to the Williams R, and we want it to be going down through the 80 and back up through, which it does tick. So that's the three parts, and as you can see, the price shoots off nicely into a nice trend. So what about the stop loss? So for that you could use a fixed stop loss. So there's variables to this strategy. Fixed stop loss, you could use the Renko block size as the stop loss level, so 16.5 points. So we got in here, so we're going to be somewhere, one of those blocks is 16.5. We'd be down somewhere, maybe that's quite aggressive, but maybe two ATR blocks there, 32.5 points. Maybe drop it below the point of the super trend turning green, or below that moving average. Like I said, a lot of options for you there. Use dynamic stop losses around amount of ATR, 1.5, 2 times. And also what I would do is I trail the stop there, maybe 1.5 times the ATR to lock in profits as it moved on up. Or you could take a physical risk reward type play, maybe 2 to 1, 3 to 1. So if it's a 2 to 1, you're looking for about 32 points before you get out the trade, so only 2 blocks. So that's a real quick old trade there. But play around with the variables. Remember, this is just an experimental strategy. The trailing stop one's going to keep you in the trade longer. I suppose one of the points you're going to note is there's not many touches. Well, we've got a few trades in there. You probably want to look over multiple markets. When these trends, the Williams R goes below the 80, and it's the same for short trades, by the way, vice versa. You're looking for the turn back from the -20. But what I'm trying to say is there, looking at our trade here, we had that nice trend, and then we had the pullback, and then we still had a decent opportunity there. But notice where the Williams R is, it's round about the 50. So we had a couple of times there. It's about not being greedy, this one, I think. Wait patiently for it to fall below 80. If you want to get more aggressive, there's nothing to stop you moving this down to say 5 to 7 to give you maybe more opportunities in. Have a play around. But that's the basics of the strategy. So what did we get over a typical back tested period of a year? Remember, this was just an experimental strategy, and hypothetical back test here over a year's worth of data. Seemed to be sufficient period, a lot of action up and down, sideways, to capture most eventualities. But again, play around with it yourself, play around with different markets as well. But results wise, 200 trades, 148 winning ones, so 74% win ratio, pretty decent there. Average win, I was using the 2 to 1 risk return type setup, 32 points. Average loss, 16.5 points, giving us our 1 to 2 ratio. Points gained, you can see there, to points lost. So we made nearly 4,000 points with a Sharpe ratio of 2.2. So it's not a bad looking strategy, but like I said, it's experimental, hypothetical back test, probably needs a bit more work. around block sizes and entry and exit points, and also, like I said, playing on different markets as well, seeing whether I get similar type results. But to start with, it's looking encouraging. So there you go, Larry Williams percentage R indicator. Looks very useful. Plenty of applications across all sorts of markets, time frames, chart types. A lot for you there to experiment with, get stuck into. Let me know if you use Williams percent R. Anyway, love to hear from you. Love to hear what sort of setups, markets, time frames you're trading. Put them in the comments below this video. So I hope you found the video useful and gave you an insight into a different indicator which you might not have considered using in the past. So if you have liked the video, please give us a thumbs up. Don't forget to hit the subs button and the bell notification button to receive updates when I'm going to be producing more content like this. Now also I've got a pretty monster playlist on the channel. It's the ultimate trading course, so if you're new to trading, it covers literally everything. Work your way from top to bottom and come out the other side, hopefully in a better place into the world of trading, to hopefully get you into that winning bracket there. And that playlist, link to that coming up right now.